Friends, and welcome to today's session on financial due diligence by CA Sandeep Shah.
This morning the topic given to me is on the financial due diligence. So I may want to probably set the morning maybe with
निशान ना लेते वक्त हमने बस चिड़िया की आंख देखनी अर्जुन की तरह
ना हम अर्जुन ना मैंने नहीं देखे चिड़िया की मैंने तो सांड की आंख दिखे क्यों जीजी ये तो मैंने करे थी मैं बुल्स आई
So what happens here with the bullseye, right? And financial due diligence is no different from the topic of this morning. But you're looking at, what are you looking for? The coach comes back and says that like an Arjun, can you see the eye of the bird? And the two women, they talk about the fact that they see nothing else, but they see only the bullseye, and both of them hits the bullseye. And the question is that whether in a financial diligence, are you prepared to hit the bullseye with preparation, with the kind of approach, or is it by fluke? And as we go through, and I'll try and use some of the simile out of this movie in terms of, as we come down the line, as to what really diligence is all about. There is enough material on the net when we look at what are the due diligences. We've all experienced due diligences in our life as professionals. Each one of us have, I'm sure, my married fraternity brothers and sisters, whoever have done their financial diligence, or your parents have done diligence on probably your son-in-law, daughter-in-law, you've done something on your to-be wife, to-be your husband, probably you as father, mother are looking at. And I think the question is, financial diligence is not really something only to do with a business approach. I think it's an approach towards the subject irrespective of the end objective. There is a method to madness is what this whole game is all about. So let's look at from the time which I have around about an hour and 15 minutes. We'll cover up as much as I can and then leave probably. This is more of I would like to leave as much time for question answers, because effectively each one of us would have distilled our experiences around the work which we have done, whether a full diligence, a part diligence, a similar nature of a work. And I'm sure there are a lot of questions or experiences which the members this morning may want to ask or share, and I think we'll try and leave as much time for the question answers. So broadly, we're talking about the content, the overview, the process methodology, the report, the key challenges, and some of the practical tips. I think that's how broadly this topic is covered off. Obviously, if you can, different people have different connotations to each of the words in diligence. So maybe if you try and put some verbose to the word diligence, it can be detailed, it can be investigative, it can be legal, it is inquisitive, it is gathering information, it is evaluating what you have got, it is about negotiation, it's about being comprehensive, and then obviously emphasizing what you are trying to tell yourself, your potential customer, and that in sum and substance is going to define that whether the purpose, the mandate for which you were engaged, whether have you been able to do justice to your work or not. So on a broad level, at a macro level, not coming only to the financial diligence, but if you were to look at broadly a 360 degree of a due diligence, it's obviously from a commercial aspect, it's obviously an investigation prior to acting or making decision. Now, whether investigation is the right word. The intent obviously is to investigate. Now the question is going to be that whether is that really going to be the end work, or is there a thought behind. We will look at what is happening around this part of the expectation and expectation mismatch. It's obviously a scrutiny of the material facts underlining the transactions or the deal before legal contract is signed by both the parties. And normally, as we know, that you may get together, you may have a small term sheets, you try and give out yourself a kind of a time frame, and then you come back and say, okay, this is my window period, and this window period is what I will allow you to scrutinize. Both what I have said, whether is it really what turns out to be, or you may have your own insight. So that's the point of time before a legally binding contract comes in. And we will look at how the evolving scenarios in this field are also becoming a kind of a challenge. And then examination of financial records done before becoming involved in a business arrangement with it. So that's broadly, and mind you, this morning the session is on financial diligence, so we're not talking about the business, we're not talking about the human resource, we're not talking about the legal, we're not talking about the other aspects which are sometimes and most of the time are work of an expert, but maybe it may happen in conjunction with the overall work. And obviously, what is the relevance of a due diligence? It's obviously to ascertain the realizable value of assets, identify unexpected or unrecorded liabilities. I mean, that's on a broader level for sure. You definitely would want to understand this. So there will be questions built around that, whether are we experts in valuation, or are we looking at existence and then looking at collaborative matters? Provide comfort to buy or sell, because it's as important, because one of the things we must always remember that financial due diligence can happen as a vendor's diligence, which means that you are technically helping the seller prepare so that when a diligence is happening on the buy side, from the buyer side, you are able to give as much information in as much comprehensive manner as possible. So it's not a one-way traffic, it's a two-way traffic. You may be representing a buyer, you may be representing a seller, you may be doing a diligence prior to a potential sale, and then obviously to know the unknown and to confirm the known. I mean, like, this is one of the, in a risk management, as we know, that the biggest Colonel Powell, the US defense, he breaks up the entire world or the entire work as the head of the defense into the 4 quadrants, and in one of the quadrant, which he for over now 20 years, he comes back and says the unknown. So if not even able to, you can deal with things which you can see, you can visualize, which you can anticipate, which you think can happen. So there can be various formats, but that one quadrant, which is the unknown, is where the real challenge happens. And even in the diligence, the question is that you have that quadrant is where the real skill, the real challenge comes in for you to be able to perform what you are supposed to be performing. And therefore, if I go back to my Sadhki arc, and then we come back and say that how focused you are is also going to be one of the outcome. So broadly, on a due diligence, you have the legal, which is the emerging discipline, the commercial due diligence on one segment, then you have the business, which is the second part. And we all know that today the big business is becoming one of the biggest challenge. Nobody probably expected that Idea Vodafone 3 years back, you commit the kind of the money, and we can't come back and say they don't know their business. Both of them are giant world over players, and the question was that today they are settled with. Now anybody would have probably taken up a view on the AGR's liability as to what is the potential liability, whether the revenue sharing arrangement, whether is it finally before Supreme Court, which way it will tilt. But the reality of matter is that It may sound very simple, but it's one of the most difficult subject to handle. I mean, like, when we practice income tax, when we practice Companies Act, we practice GST, we practice the other field, you have a section, and against that section you have an ability to look at your position or the facts, and then you are trying to match your facts with the legal section. But when you come to business, it's not about historical. Every youngster today in a business diligence can disrupt your business model, can disrupt your profit model, can disrupt your I would say whatever your growth plans are. Somebody who has no hang-ups, he has no emotions to business, but they are only trying to resolve issues, and when they're trying to resolve issues, all of a sudden you may find that what you thought is the future of business is no longer the future of business. So that's as far as and so we as professionals today, right? I mean, like today, if somebody did a diligence on us as practicing professionals, and they came back and today did a due diligence to come back and say that, okay, you are an X firm, so much vintage, so many partners, so many practice areas, so many chartered accountants, so many industries you deal with, so many business verticals you deal with. This is compliance, this is consulting, this is advisory, this is your audits. And then all of a sudden they may want to come back and say that you put a due diligence on that accounting firm, and then you come back and say that, all right, let's look at each of the aspects on that financial diligence and come back and say that whether will this firm survive and will deliver what it has delivered over the years. No different. Why go and look outside? You look inside and you do the same processes for yourself. Probably the answers will be extremely evident for you. Evaluate so on the top right corner you have human resource, one of the most important aspect. We constant challenge between the data analytics, the artificial intelligence. You know that even Sundar Pichai yesterday announced setting up global AI centers. You had SoftBank, which last week set up an AI center specifically to look at how do you, and these are, mind you, these are not pure science. These are not like your TIFR where you are in a pure science. These are in applied science. In a pure science, we are not going to be around here to witness what is going to happen, because that's something which will happen maybe a couple of decades, maybe a couple of centuries down the line. But when you look at applied science is something which you will see during your lifetime, and that's going to be your one big challenge on the human resource. And then obviously the operations, own, outsource, robotics, whatever. And then finally you evaluate the entire set of financial statements, which essentially is nothing else but the final outcome. So when we go and probably give compliment to maybe a restaurant or to a wedding party, and when you think that everything is to your liking, what you are seeing in front of your eyes, what you are tasting, is a culmination of the work. Entire backend has happened. That is what you are appreciating. And finally, diligence is that howsoever hard work you have done, howsoever notes you have, howsoever you know, but finally if that snapshot is not going to get seen by the people in and something which appeals, something which they can understand, something which they can taste, something which they can appreciate, your back-end movie has got no relevance. It's a flop movie. Let's accept one part, that if you want your movie to succeed, your final presentation will have to deliver what you have gathered in a cryptic format, right? So broadly on a financial, it includes the analysis and review of the target of the company's financial statements, the tax returns, the accounting policies, the financial trends. On the legal side, you have a thorough analysis of the corporate documents, contracts, agreements, ongoing, pending, potential litigations, environmental factors. You know very clearly, today you do a diligence on a real estate developer, and let's assume that development piece of parcel happened to be in Telangana, and if I had an accounting policy on revenue recognition where they came back and said that I will follow the probably POCM, maybe the erstwhile, while we used to have the guidance note for the Ind AS, gap continues on the real estate development, where they said, okay, you take 25% as your threshold for the commencement, for you to recognize your profits at 25% of the work done. And if one had to really, on a diligence, you will say that yes, does it match with my stated guidance note? It does. Will you find fault on the revenue recognition and probably the profitability? Probably no. But if you knew, let's take up a call here, right? So we're talking about Telangana or similar kind of a state, and you had to look forward for next 3 to 5 years on the closure of the development project and profitability. How many of would you come back and say that, look, I will be happy to look at the guidance note and allow and probably make no adjustments to the profitability numbers? Am I clear in my question? You have a development project in Telangana. The developer is utilizing the same guidance note. All conditions of POCMs are met. So I'm not saying that this will be only none of the control factors, the risk rewards, none of them are at a matter of question. So you can apply POCM, and the question is that you are doing the diligence on behalf of the potential investor into the aspect of this development, and you say that, okay, my revenue recognition policy is in compliance with the guidance note. Would you be happy or would you still have a concern? Anybody? So do I say a silence is no concern? Sorry? The concern would be there, all right. So let's look at 1 or 2 concerns. Yes, sir. Political. Yes, sir. Sir. Around? No, the project is under development. So yeah, uncertainty. Let's look at, sir, on the uncertainty. What is, and the reason why I'm saying is that there is an overlap between the business and the financial diligence, right? What uncertainty?
Uncertainty of cost.
Of cost, okay. Funding, all right. Political development. So stalling, all right. Yes. Timely completion, cost overruns. Anything else? Sorry. ROI, all right. Market, all right. Okay, so so one question, and we have at least 7, 8, right? Now let's look at one aspect on uncertainty. How many of you all would have certainly witnessed the Vedanta's copper smelter plant in Alibag? Telangana is a state, and these are my live examples, right? Because we were talking to the revenue recognition policy for a state in Telangana, that what should be your threshold level before you will start recognizing your profits, right? So do you take 25 or do you take a higher threshold? And one of the things in Telangana state is the local people, they're getting agitated over the development, resulting into either their own livelihoods getting impacted, or they're not allowing you to go ahead with the development. So this was a case where at 27-28% of your cost, you started selling you were delivering the project, a multi-purpose project, and all of a sudden the local agitation stopped the work, and now we are 6 years in history, the work has not happened. The company's over 200 crores of money is lying landlocked because the approach to that land area was through the areas where the local people never allowed you to access. So the question was that whether is 25% a kind of a barometer which you apply blindly, or do you apply a revenue recognition policy with reference to the underlying business environment in which you are going? And the reason why I'm saying, again, I'm sharing this out of context experience is because that finally due diligence is nothing else but your years of experience, whether as a tax auditor, whether as a tax consultant, whether as a GST auditor, whether as a statutory auditor, whether as a business advisor, you have understood the various aspects of various businesses in different formats, in different context, in different format. And unless we apply that kind of a knowledge onto the table, probably this subject, which is extremely open-ended. See, the difficulty is that while you have engagement with reference to a particular point, but this is an open-ended subject. It's you know that in a bypass, the surgeon knows that they have to do a bypass, but then they're opening up with the human body with every challenges when they open up, and that's exactly what happens in a diligence. So you have business, the analysis, review of the strategic and the business plans, customers, product, market, competition, operations, obviously, the analysis and review of the technology, assets, facilities, real estate, insurance, significant operational risk. So I'll share one experience on this insurance on operations on a diligence. And sometimes, what happens is that, and no offense meant to my brothers who off the record, please. Those who handle coaching classes, right? The trouble is that we're making ourselves parrots. They're teaching you something and you're talking something, and application of mind becomes a kind of a challenge. So this was a situation in an operations, insurance, so in a financial diligence. So they were looking at inventory, raw material, and then they were looking at the insurance coverage, and then they came back and said that, all right, this is a company which was into the soap manufacturing, and you know that in soap manufacturing, glycol is one of the raw material. And the question was that while the soap was insured, the glycol was not insured. And so therefore they came back and said that, they're carrying such a large value, and therefore now we must make adjustments to the profitability because next year your insurance cost will go up. Fair point, right? How many of you all understand glycol? Anybody who understands chemical here? Okay. Yes, you do. Yes, sir. All right. Ingredient. Is it can it be used by more than one industries? Okay. The format of transport is your tankers. Yes. All right. Soaps can be, if a truck got waylaid, the soaps can get dismantled easily because it is a consumer item. Agree? All right. Now, if glycol tanker, which probably each tanker is in the range of at least 1.5 crores up, right? We're talking about that kind of value of glycol depending upon the tonnage. If the truck got waylaid, how many days do you think it will take for that glycol to be used? How many? How many industries do you think will be able to use glycol? Some wild guys, come on, doesn't matter. 1 month? Probably if the number of users of glycol is soap and maybe another industry, and if it requires a large manufacturing setup to use glycol, even if they waylaid the truck, How much time does it take for it to be traced back? So this was a company which knew its business. They said that all right, we will look at self-insurance as a mechanism for the purposes of saying that yes, soap is something which even if the truck is stalled for half an hour, वो पीछे से कोई ट्रक खोल करके उसका सामान लेकर के निकल जाएगा, पता भी नहीं चलेगा, because it will get disseminated. Glycol will not. Now, if your team member applies blindly to say that, oh, this is insurance, I had learned that my assets must be insured, and if it is not insured, that means I must make up a comment. We probably, and if this happens to be your first part of the page, and probably on the, if I was a consultant to the buyer, and if this point came in, my first answer would have been that, look, your guys do not know what they are talking. So they are only mapping, and so therefore let's not talk further about the quality of the work. I'm not being rude, my friends, but I'm just trying to, impress upon the point that while it sounds simple, but unless there is an application of mind to what is the outcome, you're not going to get there, right? So obviously, operational risk, which affects the pricing, the execution of deal, and then the human resource, the organization, employee benefits, management, personal labor matters. Outsource has been one of the biggest mechanism. So that's on a large macro space. So let's look at the topic on our hand, the financial diligence. So it's an analysis of the financial affairs having material impact on the prospects of the target business, the historical and the forward looking. These are two for sure. Past is what is there and future is why they are paying for it. And then determining whether or not the company's accounts are consistent, evaluating the real situation of the assets, the liabilities, the potential tax or legal exposures and risk. And some of this we may be able to analyze for ourselves. In some of the cases we'll have to do it in collaboration with the experts in the field. But it is important that it is identified, because if it is identified, then and then only you can deal with it. What goes between your fingers is never going to get picked up. So what is important is obviously to know that you have your level. So it's like question and answer. If you have a question, probably I will have an answer. But if I don't have a question, probably I don't have an answer either, because you don't go from answer to questions, you go from questions to answers, right? So this is obviously your the point. So come back to therefore the purpose. And I love this terminology, the shock absorber, because finally, what are we trying to do? We're trying to say that you're buying an asset or a business where you want to reduce as much surprises as the real life unfolds. Just think about it, that today you have X days available, depending upon the situation, the condition under which the business has come, and they're engaging you because they want a kind of a shock absorber. They're coming back and saying that, okay, धक्का लगा तो धीरे से लगा, झटका धीरे से लगा is what they call, right? The question is that you've tried to give them as much insight as possible, and thereafter the entrepreneur, the basic tenets of an entrepreneur is risk taking, right? I mean, like, we as professionals on this side, we are right from our articleship days, we are all taught about the skepticism. छाछ भी फूक के पीते हैं हम लोग as chartered accountants, right? So today, the animal spirit of an entrepreneur is extremely different. It's not about recklessness. It's about the ability to deal with the uncertainties where the real spirit comes in. And all those who are practitioners here on tribunal matters, you all know howsoever well you have prepared your facts, your laws, your decisions, but the googly is going to come from the tribunal member. And you are on your feet. You don't have an opportunity to come back and say, sir, let me open my Google, let me open my, let me go back and let me take a time tomorrow. You've got to deal with the googly of the tribunal members, maybe of your representative DR. And if you are somebody who's good on your feet, is somebody, you are no different than an entrepreneur, because you are constantly able to deal with the uncertainty around the challenges, because you have planned your day, you've planned your affairs, you've done your homework, you've tried to anticipate. But what you are not able to anticipate is what is going to come from a double bench, or if it is a special bench from 5-member team, right? So what happens therefore in this shock absorber is that you're trying to give as much insight into potential, so that thereafter the person buys with an open eye, understanding that yes, I'm paying a value for an uncertainty, or this I'm paying for 100% certainty, this I'm paying for uncertainty, but maybe the seller is not able to handle the situation, maybe I'm able to handle the situation, right? So let's look at therefore, so whichever way it begins, so we will start from the right hand side. So let's evaluate the quality of reported earnings and identify critical value drivers. Enough of the value drivers in various businesses will be very different. In some cases it is the products, in some cases it is the distribution chain, in some cases it is your R&D, in some cases it is your HR, in some cases it is your for Apple, its value driver is about the R&D and the products and in constant introduction. Maybe for a place like Kohinoor Hotel, right? The value driver for hotel may be very different. You all have been, this was set up 17 years back, and all those members who are around for over 15 years. And if you have seen, let's say this property, are we saying in Bombay the hotel properties with banquets have not come up? Enough banquets have come up. And the question is that what has been the value driver of this property? Is it maintenance? Is it pricing? Is it their parking? Is it their open space? Is it their flexibility? Location could have been okay. Now somebody may have come back and said that if the metro can be a boon, but it can be also a disaster. So I have couple of restaurant clients. It's been now 3.5 years. The metro is getting set up there. The sales business is down by 70%. And I'm not talking about 200 square feet. These are 5,000, 6,000 square feet, 3.5 years. I know of a customer or a business which is into the tire fitments. Metro is going on for last 2.5 years. The car cannot get into for the wheel balancing, cannot come in for the change of tires. What do you do? That's so sometimes, when we talk about, so sometimes in some businesses, the value drivers may be the ability to come through and get the car through your footpath into your service area. But if the BMC comes back and stops the footpath from access, your business is gone, right? So you need to, there are multiple facets of every question in terms of what are the value drivers. You corroborate the buyer assertions regarding the target's financial position, because finally, let's admit that it's not about saying कि अब ये मेरा बैलेंस शीट है, देख लो, इसमें जो समझना है समझ लो, मुझे ये मेरा नेट वर्किंग कैपिटल है, ये मेरा सेल्स है, ये मेरा प्रॉफिटेबिलिटी है, give me this money. No, you are obviously even a fruit fellow, a fruit vendor also gives corroborative evidence to come back and say, okay, when you go and cut the avocado, it will give you a full value, right? A mango jayega, so if he's selling something for 1300 rupees in the initial phase or 2000 rupees a dozen, 250 rupees a piece, and if that mango spoils, you have a challenge, right? So there is obviously a corroborative, so there is something which about a corroborative buyer assertion to talk about what are the financial position, identify issues to be addressed in the purchase agreements, because this is a culmination of reps and warranties as we finally come back and say that okay, I'm willing to buy subject to 1, 2, 3, 4, subject to future adjustments depending upon how the deal is transacted. Somebody come back and says that no, it is as it is, where is it? If you can't manage, it's your funeral. In some cases you come back and say that no, because the nature of a business is such, and I understand my business as a seller so well, I'm willing today to take up a call. So take an example on a business where you trade receivables, right? We all know very clearly that in our profession, if the founder, the owner, partner is a critical function for you to start realizing your future outstanding bills. We agree. We agree that for us as professionals, can we come back and say कि कल हमारे critical partners नहीं है और आपकी 50 लाख 1 करोड़ की outstanding fees है, मिल जाएगी आपको? नहीं मिलेगी ना. So now the question is going to be that if the person comes back and says that look, what is the guarantee that finally your trade receivables will be received, and therefore I am wanting to make an adjustments to all your trade receivables, because we really don't know what your salesmen have gone and committed behind. उसको बोला है कि भाई अभी माल ले लो, 6 महीने के बाद में माल वापस दे देगा, अभी ये प्राइस पे ले लो, 20% डिस्काउंट पीछे से दे दूंगा. Now obviously you have done as an auditor, whatever discounts, whatever schemes, whatever is known, you would have provided, you would have asked questions, but what is behind the scene, how many of us will really know, right? And so therefore sometimes comes a question that if the critical driver is going to be continuity of at least people to ensure that in the transition phase the buyers pay their purchase price to the selling entity, those are some of the items which are obviously going to be there in part of your purchase agreements. As a strength of the financial personnel and the systems, the food is as good as the cook. So if you have the accountant who does not sharpen the knife, is constantly does not even understand the differences between the what is an adjustment to purchase price and what is an adjustment to the other income, does not understand the GST reconciliation, does not know that what does it take in terms of how do you reconcile or match your realizations with invoices. So you look at tally account open karta hai, you try and look at the bill reference and you will find all the unadjusted bills and all unadjusted payments, and then they still want you to believe that sir इसका 3 लाख रुपए का outstanding है, but अभी bill wise outstanding उसको बोलो system में से निकालने को, तो we will never be able to give you. Now if you come across a diligence where the cook is not experienced or does not want to be a good cook, you know very clearly that the financials can never be of the kind of high quality which you try to look for. Forget the outcome of the financial balance sheet. It's a basic grassroots level, because if your soil is not good, your crop is not going to be good. No doubts about it. And so therefore it's not about just getting carried away by a nice printed font or a nicely presented balance sheets where everything is a boilerplate. वो जो भी standard में disclosure policy लिखा है वो आपके accounting policy में मिल रहा है. So you find no fault with their policy, but you try and come back and say that if my revenue recognition in case of exports, they come back and say that this is on handover to at the port, That's what your policy says, that this is my risk and reward control transfer. And you open up the purchase order and you will start realizing that one of the condition of the purchase order in America is that I want duty paid clearance at my warehouse. Now, policy is there, but is that policy in consonance with what my underlying purchase order is? Answer is no. And so therefore comes a question that what do you do therefore with and mind you, I'm not talking about fraud in this case, right? I'm not this entire, we will come to an element of concern in a diligence for sure, skepticism for sure, but what I'm trying to bring here is a situation where the owner understands what it takes to do business. The owner is not an accountant, and even if he is an accountant, he does not want to be an accountant, because the day he becomes an accountant, he cannot be an entrepreneur. Let's face it. So even if all those successful chartered accountants today who are today leading businesses, you try and teach them law and you try and tell them कि सर आपने तो accounting standard तो आपने तो पढ़ा था, आप तो chartered accountant हो. Why is it that you are not wanting to understand what you studied, what you passed? But he says, I don't want to listen. Why am I having my professionals? The whole reason why he is an entrepreneur is because basically he wants to handle business. He is not wanting, because उसको अगर वो accountant ही करना था तो CFO बनता. Why would he become an entrepreneur? Right? So that's about the assessment of the strength. Obviously improve the transaction structure, because that is your value addition to the on the table. What is your value addition which you are bringing on table? Because if I am going to reproduce what is there in the books, then even the buyer's accountant can do the same thing. I'm like, why would he pay you extra money? Because his own accountant will come back and say, sir, मेरे को भी तो पढ़ने को आता है ना. Why should you really hire an external agency unless you are able to bring value addition on table? And so unless this part of the improvement of transaction structure, and whatever that improvement of the transaction structure be. So take an example, and this was a live example where there was a potential acquisition for a retail mall, right? Now a mall, maybe a business of 4 crores, property was under ownership, the business was being done, and somebody wanted to buy that retail mall because the customer base were such that they had consistent from the locations they had from the expatriates, where that locality 80% of your business came through the expatriates. They would buy everything at MRP, never negotiate over. They would, what is important for them was they needed everything which was imported, because they came here for 2 years. They wanted all good products, never bothered about the discount. So a good business, good profitability, good income, good number of SKUs, but the question was that for some strange reason the owner decided that I must not pay my indirect taxes. So do everything which the law did not tell you to do, but good business, right? So now let's look at that's your background. The target buyer is clear that this is something which I need, because it's a complementary, it enables me to increase my business's multifold. And now we have to talk about improvement of business structure. So now this your diligence, on tax diligence, you come back and say, okay, sir, historically for 7 years this is your tax defaults, this is what they have not done, so this much money we must adjust out of the purchase consideration. Now we have to look at the improvement of transaction structure. What are your options which you would want to give as a diligence consultant or as a party? So give me one option. Sell, buy, no buy. Chalo, let's take that as a first point. If you have to give your advice, buy or no buy? Sorry? Buy, no buy? Alright, all those in favor of saying no, do not buy. Sir, coin cannot be static now. So either it's a go, no go situation. So it's a buy, no buy. Buy? Alright, buy with a liability. Buy with a liability. Alright, so now so I am that buyer and I am wanting you to tell me that for last 6 years, 3 crores into 6 years, 20 crores of turnover. Tell me what is the tax adjustment I should make. How much adjustment will you make? Tax, you will determine the tax. You will determine tax, you will determine penalty, you will determine interest. Alright. So if we go by the current tax rate, the current penalties at the current interest, do you think that 20 crores of turnover will give you 10 crores? These are all 18% and above tax rates, even under the VAT. 10 crore का adjustment हो जाएगा. So you say that from sale price I must adjust 10 crores. All right. Is that what we are? Is the consensus of the house that I must adjust full interest, full tax and full penalty, right? 3 crore का business होगा, 3 times तो सर sale price कोई देवे बहुत हो गया. पिरामल ने जब खरीदा तब पिरामल ने बेचा था एबर्ट को, तो उसका सेल प्राइस का उसको 2.53 टाइम्स तो उसको सेल मिला था सर 17,000 करोड़ के अंदर में. अब इसका तो 10 करोड़ का तो उसको सेल प्राइस मिलना नहीं है, तो आप बोल रहे हो कि 10 करोड़ का टैक्स एडजस्टमेंट होना चाहिए. तो वो सेलर तो आप तो भले जो उसको तो सामने से देना पड़ेगा ना, राइट? Now this is one aspect of when we anybody else. So one is buy subject to adjustment. Anybody else who would want to give me some option around improving the transaction structure? Quick one, sir. I have a second. You have a second speaker as well, and I'm only 10 slides through. I have another 20 slides to run through. Yes, sir. Okay. All right. So we are so saddled with this thought process that when we buy business, we must buy a historical company along with the business. Why will I buy the company? I'll buy business. Let the tax liability be that of the, अगर आपको 285 का अगर आपको tax clearance लेना है तो 285 का tax clearance ले. Who stops you from getting your tax clearance? The question therefore is that having identified the question is on the flipping of the coin, and that's what this financial due diligence is also all about. It's you do not go to solution before you have identified your work. But if you go to solution before taking your work, you will fall flat on your face. The one of the most fundamental part even in audit is that because I already know that there is going to be a non-compliance and therefore I don't even take my basic steps to identify, is where we as professionals falter, because we have already come to a prejudgment कि भाई ये धंधे के अंदर में तो ऐसा ही होता है तो इसके लिए why even bother? We know the final outcome. Boss, you don't know the final outcome. You've got to go through your steps, and then when you come to the final step, that is the point of time when you come to the presentation, you come to the aspect of your decision making. That is the point of time where you change your head from a reviewer to a consultant. And if you don't have a role to play that of a consultant, and if you think that you still need to get a flesh out of or a pound out of the flesh, then unless you do this, you're not going to be able to get that pound of flesh. And then finally it is identify areas of post-acquisition attention, because this is one of the most critical aspect in any diligence. From the courtship to knowing each other, to courtship, to engagement, to wedding and post-wedding, is, we all know, whether it is the daughter-in-law or whether it is the son-in-law. Unless the next 45 days, 60 days, 90 days is taken care of, you are obviously taking chances around. You have to make things happen. It does not go by default. So activities are, you understand, therefore the objective, identify and prioritization of the risk, because that's important, because you don't have the whole year in front of you. So you identify what are your deal breakers, the critical and non-critical. Everything cannot become critical. In life, if you try and say everything is, so this was a classic example, about somebody was talking to us about in a joint venture set up by the two promoters in a business, and the question was that they came from they were friends together in college. They got together as business, and then when they became the part of the business, the question was about everything cannot become critical and deal breaker. So what they came back and said, they said, all right, let's apply the rule of the football under partnership. So you said you have red cards, you have the yellow cards. Red card means your referee does not every now and then take out a red card, right? My friend is wearing a red t-shirt, so, but you have yellow cards. And so therefore they came back and said that we will not have too many red cards among us, because which means that as our area of disagreement cannot be so high that every point of time I take a flash a red card and say, because every time you do that, that means your partnership is not going to survive. And therefore, even in diligence, when we talk about deal breakers has to be such where you are, however tempting the business acquisition is, you are willing to exit. You cannot try and have everything as red card. There is something which is a yellow and there is something which is red, and that red has to be such that if that red is something which is believed, that means you exit and you say that emotions will not overplay my finances. So that is something which is important for us to understand. Establish the action plan which is pragmatic, which is based on risk and value of investment. If I'm buying a crore of business, I cannot be spending 10 lakhs on diligence fees. Finally, everything is with reference to the risk and the price. And therefore, how do you customize your approach is what is going to define that whether are you going to get engaged or are you not going to get engaged. There cannot be an overkill in this subject. So what is the minimum baseline? Yes, there is no doubt about the fact that there is a minimum baseline work which has to be done. Now, but that minimum baseline cannot be 99% of your outer baseline. You must understand what that baseline in your industry is, the type of analysis to be performed, and then your field work, which is your review and analyze information for its accuracy and reliability, and then finally the tailor-made report. It is not one shoe does not fit all. Please mind that there are different receivers of your report, and therefore you cannot come back and say what worked with an X client will not work with Y client, because the approach of X and Y is going to be different for the same set of business. I'm not even saying for different set of business. I'm saying that what X is looking for as an entrepreneur and what Y is looking for an entrepreneur, or what CFO of X is looking at and what CFO of Y is looking for the same set of business is going to be from a different eye lens. And so therefore this is not your 3CB report, and this is not your 3CA report, or this is not our SA 700 report where you have a standard structure. You will have to have yes, because you have the framework SRS 4400, so you have some kind of a structure, but the rest has to be a tailor-made report. So quickly, in terms of what are the kinds of the diligences which happens, you have a full access, open door, come, analyze, look at anything and everything, I don't mind you go and talking to my partners and you talking to my people. Full access. Very, very rare situation in today's timeline, because the perception of the entire audience from your distributors. So today if somebody is talking to an accounting firm, and if you start allowing 100% of your people to get spoken to by the potential firm which is wanting to do a JV with you or is wanting to do a full buyout, depending upon what is the perception of the opposite person, your people may start looking elsewhere, because they feel that, oh, I don't want to be under such a stringent environment, and so therefore they may come back and say that, look, I don't want to, and so before you have realized your money, the critical people on whose strength you are earning will start disappearing. What you will be left with is probably a client who will also remain for some point of time, because you will finally need people to service them. Right? So full access is a desire, is a dream. In reality, does not happen. Gone are the days. We've seen full access in earlier years, but of late we're not really seeing a full access. Limited access, which is to the target management, to staff, to accounting, financial and legal data, because finally there are going to be critical people in every organization who are your confidant, because finally the owners cannot generate everything. So there are going to be one person who's your key people, who are your confidant, who knows that without giving the end purpose is still able to give anything and every information, and he will still survive through the entire ordeal, irrespective of whether the business is taken over or not business is taken over. So you will have a limited access. You may have a no access, which is a strictly controlled environment, typically based on publicly available data. So you make your homework, you talk outside, no name basis. Google is not obviously to your answer, so you have your antennas up, but you can have a situation where they will come back and give you financial statements, they'll give you some sort of internal MISs, but they will not allow you to touch anybody. You do whatever you want out of your public domain, and these are large deals. Some of these deals runs into millions of dollars, but because of the sensitivity around the outcome, you will have the situation about no access, and you are also a supporting person in this element. So you can understand that you're really in a dark room and you're still trying to visualize and still be relevant to the client. And then you have a virtual data room. This is another very, very prevalent framework. No access to your IT database. You have anybody here who has experienced the inspection in the registrar of companies. My youngsters will not know, but you knew that when you went, my senior sir would know here, you were allowed to only probably not even take your pen. It was only the pencil. Yes, ma'am? Only pencil. So you cannot go back and start tampering. You go, you make your request, you are up there in the room, you analyze, you make your notes, that's about it. So you don't have an opportunity of asking questions, but this is also another very, very prevalent kind of database, and from that you have to be able to make, so what they are giving, what you are analyzing, what are you making out of it? What is your next step of questions to be asked for? Because you have no ability to interact. This is a extremely, I would say, resource quality experience based work, which is important when you are getting into either limited, no access, or a virtual data room. You can do on a buy-side diligence, which is to ensure the prospective investors makes an informed investment decision. You can represent the sell side, what we call as a vendor diligence, around analyzing the opportunities and risk facing their company prior to sell. Because it is also important that you don't knock on everybody's door, right? So when you're dealing with a vendor diligence, this is not like a salesman that I have a Ray-Ban in my pocket, sir, aapko chahiye, because Ray-Ban's value does not get diminished. But if you had a business and you went and knocked on 10 people's door and say, I'm a seller, with every possible person whom you meet, there is a value destruction rather than a value gain. All those who have, who have bought houses, and you have the buyer who goes and, it's a reverse way. The seller talks to one broker, talks to second broker, तू 2.5 देता है, नहीं मुझे 260 चाहिए, तू 260 वाला लेके आता है, मेरे को 260 नहीं, मुझे 270 चाहिए, 270 वाला बाद में 280, फिर फाइनली वो 210 में बेचेगा. Because you are also not clear, because finally the beauty lies in the eyes of the beholder. There is no rocket science to come back and say that whether will I get 1 crore of rupees, or will I get 100 crores, or will I get 500 crores, or will I get 50 lakhs, because finally what appeals to a buyer is, in their context, you on a vendor side must know very clearly that how do I, without giving lipstick to my program, to my business, how do I bring the relevant facts and then identify the relevant buyer so that the relevant buyer sees value in what I'm selling. And that's where the financial diligence as a subject comes in. It's not only about putting your house in order, it's not also about making your data available swiftly, also to know that if there are questions, because if you are to do on a buy side, you know what side of questions are going to come. Now you are preempting those questions on the sell side, and you come back and say that all right, let's have our things in place so that the confidence which the diligence team comes and looks at least feels that you know that you've got a firm grip over your, at least as far as your financial accounts, your documents, and your answers around the adjustments, either in terms of the purchase discounts, the sales discount, in terms of your inventory write-downs, in terms of your, the obsolescence policies, your amortization of your assets, anything and everything, you have valid answers to give as to why what is done is why it is right. And if it is not right, you are at least coming back and saying that, look, how am I going to generate value of business out of the business as it exists, and you then prepare your seller to come back and say that you must be prepared for this kind of adjustments, because this is exactly what is going to happen. And the seller should not get dejected that, look, agar aapne mere ko pehle se bata hota to maybe I would have upped my price. It's also, discovery of price is also an important aspect in a diligence. Seesaw, as a child, we were always on a seesaw, and we were always coming back and saying if somebody was a stronger side than I was, then I never was able to balance it. So you were always trying to look for that balance even on a seesaw as a child, right? So identify deal drivers and deal breakers, and this is one of the toughest part. This is not like your the balance where you have a weight of 1 kilo and you have the business, because what you not have in your hand is the weight. And so therefore, if you don't get this balance right, you have a challenge. So that challenge, the technology, the brand, the revenue, the only asset, the key personal profit, licenses, customer base, whatever are the aspects. Because if I have a technology license, and the technology license after 5, 7, 10 years comes back and says that I can actually sell it to anybody else, which means that you have, as an entrepreneur, you have worked hard towards establishing the business, and now all of a sudden the technology owner after 5 years comes back and says that now I will open up the ground to everybody, right? And the question is going to be that if it opens up, am I going to be in a position to do the same value of business with the same level of profitability going forward when there is going to be an increased competition, and where the seller of technology as an option, because the seller of technology also is not wedded to one person. There is no exclusivity built around that. So today you had situations where, so if you did a diligence, let's say on a automotive dealer, right? The big brands, you need at least 15,000-17,000 square feet of your paint area. You need minimum 100 cars in your distribution channel. you have high paying executives because you're selling an S class or you're selling the expensive cars, and you have a distributor who's operating out of Mulund or operating out of eastern zone, and then there is somebody who are in 2 kilometers down the line is also operating out of Bhayandar. Is my cost economics of the land area equal? No. S class sells at the same price. My land area, which is different. Now if they start opening up the S class in 2 kilometers, and if they start discounting, where is my business? So the question in diligence is also to be able to understand that whether the commercial consideration the owner has done with the vehicle manufacturer, how have you given a sunset or what we call is a radius, sun radius as we call, that today there are, in some cases there is a 30 kilometer radius, in some cases there is a 50 kilometer radius. You cannot come back and say that you can open something in a 5, 7, 10, 12 kilometers, 15 kilometers distance, where on account of the underlying cost economics, my business is going to become unprofitable. Obviously, audit and financial diligence, there is a huge difference between the audit and a financial diligence, where as far as the opinion is concerned, it's true and fair. Whether here it's on a commercial aspect, there you report to the shareholders, here you have a target which is your investor or the seller. Timing is annual closing, this is prior to transactions. Attitude is watchdog, here it is more of an investigative. Access is full access, because that's what, there cannot be any restriction to your documents. And then here it can be a controlled access. So these are two broadly large ones. Approach is obviously the deep understanding of the financials, the diagnostic approach. We all know that a difference between a good doctor and a not so good doctor. I'm not saying bad doctor, I'm saying good doctor and not so good doctor. Both of them have the same set of reports, but the outcome is very different. Somebody who looks at an X-ray is able to identify a probable tumor, and there are other sets who are not able to identify. Therefore, they will come back and say that, oh, now from there we must do a CT scan or we must do an MRI to identify, because I'm not able to see. And there are some who understands human anatomy to such an extent that they're able to spot in an X-ray even a tumor, right? So a diagnostic approach is important, that it's not just about the physical numbers, but what is behind the physical numbers is what this approach is all about. Give insights, meet timeline. We all know newspaper has value at a bus stand. If I have a very senior member sitting here, and he knows very clearly that you have a bus depot in Old Deer, sir. 7 बजे का बस है, अगर 6:45 को अगर न्यूज़पेपर नहीं लगा तो 7:15 का वो all written, right? So the value of your work is provided the timelines are met. You give after the timeline, it is just a piece of paper gathering dust. And then obviously correlate and analyze. These are on your and if you look at the structure which has been used, this is if you understand honeycomb, right? There are bees which does exactly without being taught, but it's done in perfect manner, so that finally the honeycomb is able to give you nectar. And that's also about that, whether your work is going to give you nectar or is not going to give you nectar is going to be your entire focus and approach towards work. So the process. So you decide to sell, you have some pre-marketing, you have marketing, you have preliminary review of the bid, you have a diligence, you have the final negotiations, and you have the final sell-off. This is as far as your seller's perspective is concerned. From the buyer side, generally the beginning point is the strategy that I want to acquire something. I don't know what I want to acquire. I have money. Maybe sometimes I have a next generation coming in. I have wealth. And I know very clearly that too many people, kith and kin in the same family, if there is not going to be sufficient business opportunities, they are going to cut each other. So they are going to come back and say, empty mind is a devil's workshop, as they call. So sometimes it is possible that the business does not have sufficient traction for number of family members, and therefore sometimes it is possible that they want to establish a new set of business. And so that can be your one strategy of what I want to acquire, or I may want to expand, or I may want to go sideways, I may want to go whichever way, top down, whichever way I say. Then okay, having done that, you identify, you want your approach target, then you have valuations, you have diligence, and you have negotiations. I mean, that's how essentially the buyer's perspective. Very rarely you will find that somebody has knocked on your door that I am a seller and all of a sudden an interest is created. Possible that it was not in my strategy, but I found the opportunity to be so great, as we call the happenstance, right? You happen to meet somebody and therefore it gave you it was not on your cards, but you made that opportunity or a chance meeting into an opportunity, quite likely. That's the therefore if you thought what was that blank for, that blank was that if it was not a thought through process, whatever may be the reason which gave rise to an opportunity. So the scope should be defined and documented so that you don't want a kind of expectation mismatch, as I would call. Limitation of scope to examine its implications on the deal, and why I'm saying also the scope should be defined and documented, because you see in many industries or even in our human life we have matchmakers, right? Now the matchmakers, the question is that in the matchmaker, are you expecting them to give you an additional insight into the habits of the bride and the groom, or are you saying that no, this is what I've been able to accumulate, rest is all yours? Depends on what is the person. So sometimes unless you force yourself to come back and say that let's have at least a reasonable clarity of what you want, this can be a potential time bomb, because the buyer, if they do not give you this scope and if they lose money, you lose the client, because they are not going to blame themselves or their organization or their the way they've handled the post transaction, but they will come back and say that, oh, my consultant did not do the job correctly. So you don't want to be in that space. You have the limitation of scope, and so examine implications, and obviously superimposed by the investor, because anything additionally which they are wanting you to do. So quickly you look at the control environment, identification of the overstated revenue, understated expenses, working capital, capex. Incomplete capex is an important aspect. What is the operating leverage in the business? You're identifying significant contingencies and commitments, highlighting post-acquisition integration issues, key personnel and management track records, related party transactions. This is another extremely important, because most of the time the buyers will not allow the related party transactions because they cannot have competition for the product which they are buying. So it is important for us to know that if there are because in erstwhile scenarios for the SSI benefit under the excise duty, you had two side-by-side factories under two different legal entities. In one you had another in one, but both of them combined, put together, doing this finally executed business, and you come back and say I'm seller for X and I'm not seller for Y. Does not work. whatever may be your legal reason as to why the two entities were set up. There may be cross sharing of facilities because you have the same common inputs, maybe you have the same designing, maybe you have the same QC. So it's important for you to understand what is the dependency on related party transactions for the purposes of your diligence. And then you assess the recoverability of the assets and completeness in recording the liabilities, because that's what is going to define your. So if your bills are being booked just on the day on which the payments are made, and if that is your due diligence, you know very clearly that there will be some 10 box files of bills which have yet not got either approved, or they're approved but they're not passed because the owners have said that it is not ready for payment. And so therefore you will obviously be left with a kind of a challenge, and you may wish that my diligence should happen in month of October when my September results are already out. So I've done 6 months post year transaction, and therefore everything is accounted. But what happens if you were forced to do an accounting on or a diligence on 1st of April? You don't have a luxury of post period advantage, and you still have to therefore come back and look at how many unrecorded liabilities would be there. Right, so this luxury of time past is something which is not available in your diligence, because diligence is not a planned activity. It's never a planned activity. It can happen at any point of time, and therefore unless the bandwidth, unless your ability to respond to the request, unless that is going to happen, no way you're gonna be able to fill that gap. So you have your profit and loss, which is your erroneous accounting, one-time extraordinary items, your in-days adjustment. This is one of the biggest challenge today we as diligence is facing, because not full retrospective. You have the 115 now, which so therefore you have the modified. So what has already hit your P&L, what has already hit the retained earnings. A big challenge in terms of, so if you pick up any of the annual reports, you will have the 3 years of data which is under IGAP on your statistics. You will have the 2 years on the in-days adjustments. You cannot even make out head and tail of 115. So if you had to do Mahindra Time Resorts, 115 is spread over 20 years or 25 years of their relationship, whereas the gap was 60% year one and balance 40% over the next 5 years. No comparison to your revenue vis-a-vis what was there in the gap and what is happening in the in-days. Segmental and divisional profitability, your segments under 17 and operating segments under in-days, two very, very different methods. So unless you understand in-days, unless you understand gap, and unless you are able to reconcile the put together, you cannot come back and say, look, I don't understand कि भाई ये तो gap का segment है, ये in-days का segment है. Thank you, bye bye. They are not interested in your gap and in-days. They are interested in understanding what is my segment on like-to-like basis over the 5 years. Either you bring in-days to gap or you bring gap to in-days. Does not matter. But I must have, everything must talk in the same language. Your under provision of expenses, quality of earnings on balance sheet sides, your adjustments to the assets including in-days, usable, impaired, unrecorded or unstated liabilities, management estimates. This is one of the biggest challenge about the estimates as to, so you pick up balance sheets and you come back and say this year my sales return were higher because of the competition in the market, or because of the new product, or because of the climatic change, but I don't believe my next year I'm going to have the same scenario. Now you still have to now you will come back and say that the auditor should have also equally challenged the management estimate. Why should my management estimate challenge be any different from the auditor's challenge? The whole reason why you are there is because if we as an auditor and we as a consultant, if both of us played the same hat, then one of us was irrelevant. So it's a reality of life which we will have to deal with. And then his adjustments on the operating cash flows. How well do you read cash flows? Because cash flows is something which is in every organization, unless they are good, this is the last thing to be done. Oh, the accountants are always struggling, your articles are always struggling because they really don't know how to match the cash flows. And if you read cash flows correctly, it can give you a lot of insight in terms of how the cash are being managed, what is the constituents of your cash and cash equivalents, and what is your, how do you treat the government grants, and how do you handle the factoring. You will, if it is long-term borrowing, short-term borrowings, if they are giving you net in your cash flow disclosure, you know very clearly that the person has not applied the accounting standard, because the accounting standard does not permit you to show your long-term borrowing and borrowings and repayments on a net basis. Because the moment they give you gross, that you would know that throughout the year how have you managed your short-term borrowings, because at the year end you may see a nil borrowing, but on a cash flow you will see long term, and you will see the borrowing and you will see a repayment. So this is going to be your first fundamental indicators for people to know that if you look at cash flows, that's what I would do. I mean, like, if I had to make a judgment on a audit report, my first soft targets are some of these disclosures, because that defines that how good the management and the auditors have done their homework. And then the quality of your disclosures, policy notes on your MDAs and your audit report, of balance sheet items to be minutely scrutinized, methodologies, review term sheets, MOU, LOI, your collect industry and target information, internal, external evidence, analytical procedures for performance analysis, trend analysis. How much do you do a trend analysis more exhaustive and in-depth as compared to audit? That's obviously your methodology. Stress on value to buyer concept, internal communication within the team, timely sharing of work results to the client, use of experts for industry specific matters. I mean, there's no denial on this. Report, obviously it's confidential, so your background, your transaction, your scope limitations, your key finding, what is your adjustments you are suggesting for the earnings and to the net worth. So what is your adjusted EBITDA and adjusted net worth, what is your analysis and detailed filing, limited review of projections if part of the scope, other matters and annexures. You generally would have to have a kind of a structure so that you know very clearly what to look for, where to look for. And a synopsis is what is therefore important. The headlines are as important as the body. We all know, all those who are readers of newspapers, we know very clearly that whether a full article will be read or not read, there are two ways in which it will happen. One is that you read because you like the author, because you know very clearly that that author will add value to your time, or second is that the time headlines are such that it induces you to look at, and then when you look at your eyes on a couple of lines, you know very clearly that the rest of the paragraphs will be read. And that's what is going to exactly happen out of your due diligence report. If it's going to be a 500-page report, tell me, annexures can be kept separately. No point on reproducing things which does not add value. So the key challenges: people. You are in a maze, you don't know where to go, you take a wrong road, you will be circulating within the maze, and your time is up. Clearly, I mean, like, there is, and if your critical team member takes up a road X, the other takes road Y, but if they don't know where to meet, then also you will have work which is done but which is not reported. So I mean, like, I cannot, give a better perspective to due diligence than this. And then the skill. No two opinions about the fact that if you are able to handle the maze, it is about the training, the experience, the ability, the growth, the advanced training, the knowledge, the learning, and most important, the competence of everybody. I mean, this is going to be the most critical. So if there is a critical driver for the client whom you are identifying, your critical driver from your side is your team members. So what are some of the things which you should be aware of? There are going to be traps set by the seller. You know very clearly that world over, diligence has got different connotations. So if you're doing diligence on behalf of a Japanese business entity, the culture in Japan is not beware customer. They would want to leave behind on table something more and not something less. So Japanese do not by culture believe that I'm street smart and you should be street smart. They are people of great culture. They value relationship beyond sale, and therefore if you buy 100, they will give you value worth 105 but not 99. That's the Japanese culture. You go to other parts of the world, they will say that if you did not do your homework, you did not do your homework, if you did not know your business, it's not my funeral. And so therefore you as a customer should have been beware. So it's important to know that whether there are traps which are being set by the seller, and if you think that the seller has to be honest, should be the moral guardians of your business, depending upon the scenario, depending upon the businesses, depending on the country in which you are doing businesses, you may have pleasant experiences, in some you may have not so pleasant experiences, and you may feel dejected, you may feel cheated, and you will curse yourself that, oh, why did I not realize this. So it's important for you to know that there is something called that the traps are set by the sellers, and if you cannot know the traps, you will be the mouse inside. So sometimes you may feel that, oh, the traps are evident because you can see a typical trap. Sometimes you will find that there are gum pads, and that in the moment those gum pads are there, which means that you are not able to even take the next step, because they have given you चक्रव्यूह में इतना आपको फंसा दिया है कि आपके पास में 10 दिन के अंदर में 8 दिन तो आप वो चक्रव्यूह में घूम रहे हो. You think that you are working, but you are simply on the rocking chair. You think you are moving, but you are there where you are, except that the chair is rocking. Important for you to know whether are you making progress, are you not making progress, are you stuck, whether are you going round in the merry-go-round, because it's an art and it's a science. So information in a bulky format, delay in providing information, not solving queries, recurring items, treating them as when they should have been extraordinary or one time or exceptional, they are being treated as regular, stuffing distribution channels to inflate sales projections, exaggerating potential benefit of assets, whatever may be the trap. Your other key challenges are limited access, no access, multi-location, scope not known to all members, and hence the risk of non-detection in certain areas. The orchestra, the Mark Zubin does not become the maestro for nothing. He's got a troupe of 100 people, and everybody doing what they're supposed to doing in unison, silence by hands, and he's got a stick in his hand, and somebody comes back and says that what does he do with that stick in the hand? He's not hitting them, but he's getting the best out of it. So unless you happen to be that maestro, you're not going to get the best out of your team members. Absolutely. And if you think that there is no preparation, there is no on-site, there is no training, there is no eye contact, you're not going to get results. You will have body, but you will not have results. Time constraint as deadline due to the nature of the deal, because this is always as of yesterday. I mean, this is the risk of this is as of yesterday, and so therefore you cannot be complaining that I always say that a person who's handling your the casualty ward of a hospital, can he complain? Oh, that the patient now got injured, he should have, informed me. But the guy, he's there in the casualty ward because he's expected to deal with casualty. The casualties do not come announced. And that's what is the reality of life even in diligence, that it does not come announced. And so therefore, how you gonna be able to handle the work is going to be extremely clear, that whether is this one of your focus area or this is one of your byproduct, or when I have a time I will do diligence. Then if it's a byproduct, then I think you will never be able to deliver what you are able to deliver. I mean, because the skills, the competency, the understanding, the pressure of time, producing results is extremely different from a regular audit process. So obviously the exhaustive list of requirements, but relevant. Contradictory information replies, look for that inconsistency. So ability to be able to have looked at one, so all those in childhood days, spot the difference, right? It's no different. I mean, you've looked at something here and you look at something here, and then you should be able to come back and say that it's not side by side picture, but I should be able to spot that there is an inconsistency between what X said and what Y is saying and what X and Y put together is saying. So look at your internal audit reports, the defensive attacking, the 5 minutes. DDR, so update your list periodically, time track period of replies, ascertain the reasons for resistance in providing data. Important, because this gives you a clue as to that if they know what your questions is leading to, they obviously are as smart as you are, or probably smarter than us, and so therefore they are trying to stonewall or trying to divert your attention. So you must know the evasive replies, the replies which are being staggered. Look for deferment or expedition of transactions. Review transactions with related party, we already spoke of. Gut feeling, finally, we've seen even in this morning, we have had this one of the largest buyer. Most of them, they've said that they've bought things through a gut feeling. Thank you.